Hello everyone, it's time for this week's market analysis. On this channel, we break down trading strategies and insights in a way that's easy to understand, all through chart analysis based on Dow theory. If you want to dive deeper into the methods we use, there's a link to an explanatory video in the description. Be sure to check it out. Let's get as good at technical analysis as a raccoon is at using its paws, crafty and quick. If you found this video helpful, please give it a thumbs up and subscribe to the channel. Now let's jump into this week's market. Let's take a look at the EURUSD chart. First, we'll review this week's price action. This is the weekly chart. This week, the market formed a bearish candlestick with wicks on both sides, commonly referred to as a doji, indicating a small real body and very little overall movement throughout the week. Price reached the resistance line, which aligns with a previous weekly swing low, and was rejected, halting the upward momentum. Going forward, since the market remains in a high price zone, we'll be watching to see whether price can break above the recent high or whether a corrective pullback develops. Next, let's look at the 1-hour chart. The yellow vertical line marks the beginning of this week's trading. At the end of last week, all time frames from the weekly down to the 1-hour were in uptrends. Currently, the 4-hour swing low is at this level, and the 1-hour swing low is here. After the market opened, price attempted to break through the weekly resistance again, but was rejected and fell. In this section, we can observe a series of lower highs and lower lows. While the swing low wasn't broken, some traders might have viewed this as a downtrend. However, the subsequent rally broke the previous high with a solid close, confirming that the trend remains bullish across interpretations. Next week, the key focus will be whether price attempts to retest the weekly resistance. Now let's go back to the weekly chart and review the current market structure. We see the market in this pattern, and since price broke above the resistance line, it can be judged as an uptrend based on Dow theory. Also, since a new high was formed, the new swing low is at this level, the low before the recent high. In this zone, it's safer to look for trades either by shorting near the highs or buying from lower support levels. That means selling near the weekly resistance line or buying with the swing low as your protective level. Moving on to the daily chart, we interpret the trend in this structure. Because price has made a new high, we update the swing low to this level, which aligns with the weekly swing low. This area remains a key level for trend reversal, so it's a good idea to plan for possible buying opportunities on pullbacks. Some traders may also identify this section as the swing low, so price action around this zone should be watched closely. Let's continue with the 4-hour chart. Currently, price is moving in this structure. The swing low is here. As discussed in last week's video, since the swing low wasn't broken, we expected a possible rebound, and that played out. If this had been a valid double top pattern, we would have wanted to see the neckline act as resistance or a drop after the first rebound. However, the recent rally invalidated that bearish scenario, and the market is moving more like a range, making it harder to justify a short entry. Since the pullback was deep, if the price breaks above the recent high again, the 4-hour swing low will move up to this level. If that new swing low is broken, it will signal a downtrend on the 4-hour chart, making it easier to consider short entries. Now let's look at the 1-hour chart. The current market structure looks like this. The swing low is here. Some traders may view this as the swing low, or consider the lower highs and lows as signs of a downtrend. However, since price broke above this high, the market can be considered to be in an uptrend. Summarizing all time frames, the weekly, daily, 4-hour, and 1-hour charts are all in uptrends. As such, rather than buying in the high price zone, it may be more advantageous to wait until the uptrend becomes overextended and look for short opportunities. Now let's go over the potential trade scenarios. First, the short scenario. As mentioned earlier, the market is currently in a high zone, so ideally we want to wait for the trend to become exhausted before entering a short. This week, price tested the weekly resistance again, but selling pressure was relatively weak, and the market moved more like a range, suggesting that shorting from the current level is risky. However, if price tests the weekly resistance again and forms a clear reversal pattern, it will provide a better opportunity to short. In that case, if price rises above or returns to the same high, the swing low will move up to this level. A reversal that breaks this new swing low would make it easier to enter a short. It's also worth considering the possibility of shorting from the next resistance zone above. Next is the buy scenario. Since the weekly resistance is directly overhead, buying from the current level is risky. As with last week, we recommend avoiding new long positions here. If price pulls back to the swing low area, there may be short-term buying opportunities. However, such a move would suggest stronger selling pressure, so it's also necessary to consider a potential bearish wave structure. While the long-term trend is still up, it's important to remain aware that price is still within a high zone. Next week will likely be about looking for safe entry points for short trades from this high area. Did you find that helpful? If you did, please give this video a thumbs up and subscribe to the channel. Next week, let's be as skillful with technical analysis as a raccoon is with its paws, and trade with the same caution a raccoon shows in the wild. I wish you all successful trades. Best of luck.